Today, we're going to be talking about which financials you should be looking at. The best place to start is always the balance sheet. Review your cash balance, any other assets you have on your books, and your liabilities to make sure those numbers all make sense and are correct before looking anywhere else. If your balance sheet is wrong, I guarantee you that your profit and loss is also wrong, and likely your cash flow statement. Once you're sure that your balance sheet is correct and accurate, that's the best place to start, because that will let you know at the current moment in time what your total assets were or are, and what you owed in liabilities and who to. And once you know those things are correct, you'll be able to tell how much equity you have in the business. The balance sheet represents your company's financial position at a moment in time, not over a period of time. It tells you exactly how much you have in the bank right now, exactly how much you owe the credit card company, and exactly how much you owe the state for sales taxes. Once you start to see your liabilities are outweighing your assets, then you know that changes need to be made. Here are some examples of 3 balance sheets. The first one is very wrong and should be corrected before any other financials are looked at. See that negative cash balance and the negative credit card balance? Who's overpaying their credit card company by $1,000? The next one is a perfect representation of the position of the company. And the third is one that is correct and accurate, but the company should consider making some changes as they don't even have enough cash to pay their upcoming liabilities. After you ensure your balance sheet is accurate and you understand what it's telling you, it's time to jump on over to the profit and loss or income statement. You can run a profit and loss for any period of time you wish, but usually the ending report date is the same as the balance sheet ending report date, so that you can compare apples to apples. Now the reason for this is that if you know your balances on your balance sheet are correct at April 30th, that means that your profit and loss is also good to review at April 30th. But if you run your profit and loss for the first 6 months of the year and you review your numbers, transactions in May and June might not be accurate because you only verified your cash balances and credit card balances through April. So some transactions in May and June may have very well been miscategorized in your books. The profit and loss will tell you exactly how much sales you generated over the period of time, and depending on the business and the detail of the financials, you might even be able to tell exactly how much sales you generated from each stream of income. Then, it will show your total cost of goods sold, or your cost to buy the product, goods, or services that you eventually sold. Cost of goods sold can also include things like merchant processing or credit card fees, shipping, supplies to ship the items, etc. Now sales minus your cost of goods sold gives you your gross profit. And the gross profit is a very important number to understand because once you know how much money you're left with after you make a sale, you'll be able to project and budget for the number of sales you need to generate to earn your desired income. The last section of the profit and loss statement is overhead expenses. Now, these are the expenses you'll have as a business owner regardless of whether you make $1 of income or $1 million of income per month. And while these aren't nearly as variable, which means that they increase when your sales increase, just like cost of goods sold, overhead expenses like telephone, rent, office supplies, website maintenance can definitely increase as your business grows. So the overhead expenses are very important to monitor because you need to know how much you're spending each month, regardless of whether or not you make a sale. But you also need to make sure that your costs aren't rising out of control as you grow, which can happen very easily. So here are 3 profit and loss statements. The first business is 3 months old, still growing. The gross profit percentage is consistent and good, but they haven't turned a profit yet because their overhead expenses were so high. They put a lot of money up front into their website. Now the next is a year later. Sales have grown significantly, and because of this, they could afford to purchase more inventory at a cheaper cost. so their cost of goods sold as a percentage of sales has decreased. And because overhead hasn't increased much, they've been able to financially benefit from that. And they actually turned a profit. The last example is 2 years later, when they got too big for their warehouse setup, and they had to move to a new facility, hire more workers, and all of a sudden, they're not nearly as profitable because of all their additional expenses. So they either need to cut costs, whether that's cost of goods sold or overhead, or they need to increase prices. Keep in mind, it's not always about sales. You have to grow smartly, not just quickly. Once you've mastered the first two financials, the cash flow statement is the last one to look at. Now, it's important to understand the cash flow statement when you're just starting out, but also really important when you're bringing in serious income because you want to make sure you know exactly where that money is going. A cash flow statement will organize your cash inflows and outflows into 3 sections: operating activities, investing activities, and financing activities. So you know if you're spending cash to keep the business operating, to purchase new investments, to invest in the business's future, or if you're using cash to pay down debt. Some examples of the cash flow statement are below. It doesn't follow the same exact activity on the balance sheet and profit and loss that we used as examples, since they're simplified versions of financials and don't have enough detail to show a full cash flow statement. But the examples do show that a cash flow statement makes it really easy to identify where your money is going and where it's coming from. Most of the business's cash will be used for operations, which is the first section. But investing activities, whether that's buying or selling assets like equipment or other businesses, and financing activities, paying down debt, are also very important areas to keep track of because cash can go very quickly. Once you have the sum of all cash movement in the period of time that you're looking at, then you take your beginning cash balance from that period, add it to the change, and you should be left with your ending cash balance, which is exactly what's in the bank at the end of the time period you're looking at. This is a great report for planning, both short-term and long-term. And combined with the balance sheet, it helps you visualize whether or not your business will be able to fulfill all of its future obligations.